Hello, everyone. Nick Ryder here with Kathmere's Chart of the Month. This month's edition is focused on a topic that's come up a lot in conversations I've been having with investors about what to do with their safety assets, those for which the principal objective is stability and income generation as opposed to long-term growth and capital appreciation. One question I regularly receive on this topic is, with money market funds in treasury bills yielding north of 5%, why wouldn't I just park my money in cash or T-bills and collect 5+% a year? Put differently, why bother with bonds? This sentiment is especially understandable considering the current yield environment where treasury bills currently yield 5.5% and 5-year treasury bonds yield a full percentage point less, or 4.5%, as shown on the chart on the far left. In my August of 2023 chart of the month, I addressed the trade-offs associated with very short-term instruments like money market funds and T-bills, namely that with cash-like investments, investors are taking on reinvestment risk in exchange for avoiding market price risk. As a reminder, reinvestment risk is inherent in cash-like investments because rates aren't locked in for long due to their very short-term nature, and thus are subject to the risk that rates will decline in the future and investors will be left accepting lower yields when they do. The middle portion of the slide shows that investors today face a very similar dynamic to the one that existed at the end of 2006, which was the last time interest rates were both this high and when cash yields exceeded those on short-term bonds for an extended period of time. Like today, investors at the time were susceptible to being lured into what I'll call the cash trap. The right-hand portion of the slide shows how the cash trap came back to bite investors in the years following the end of 2006. We can see that over the next 1, 3, and 5 years, short-term bonds noticeably outperformed T-bills as interest rates subsequently sharply declined and T-bill investors were left stuck regularly reinvesting at lower rates. To be clear, I chose this example not to suggest that I'm anticipating an exact repeat of the events that transpired following 2006, but rather to demonstrate two key points. One, cash-like investments carry a very real risk, which is primarily one of opportunity cost. And two, there's more than meets the eye when evaluating fixed income investments than simply looking for the highest current yield. That's all for this time. Thanks for joining us, and we'll see you next time.